practices. And bank earnings disappoint. Commerzbank warns its revenue is likely to shrink this year. Its CFO tells this programme that this year's income will depend on risk provisions. Matt?
Let's take a look at futures right now. We are seeing gains across the board, and they're not huge gains. We've been talking about this all morning. They are about 1/10, almost 0.2%, and U.S. futures are looking pretty similar as well. Take a look at the global macro movers screen as we open up across Europe right now. You'll see the left-hand column has equity indexes, and it populates as they open, and the FTSE, of course, is already there, up about 1/10, now 0.2%. So the British index is rising this morning. Typically, we see Spain open next with the IBEX in Madrid. It's been a rough couple of days for the IBEX. Now it's unchanged, you can see, but it is also rising as we watch the first few trades, gaining now 1/10 almost of 1%. We'll see European equity markets then, it looks like, for the most part, open just barely higher, maybe even looking for direction in some cases as they take a little bit longer to open up. That's as investors weigh the implications of weaker than expected inflation data, CPI, I guess depending on how you look at it yesterday, maybe a little bit of a disappointment. Maybe it's a good thing that we don't see runaway inflation. It's a key measure of prices paid by U.S. consumers, and a lot of them would disagree with the numbers. I know because I get so many emails from people saying, inflation is here, I feel it, but then those people have been emailing me the same thing for the last 20 years, so maybe take that with a grain of salt. Right now, the Fed is the other big story. Chair Jay Powell says the U.S. job market remains a long way from a full recovery.
There could be some upward pressure on prices there. Again, though, my expectation would be that will be neither large nor sustained. You know, in major part, we are looking at actual inflation. We want to see actual inflation.
Joining us now is John Rowe, Legal and General Investment Management, Head of Multi-Asset Funds. John, what's your view on inflation? I think for a few days it looked like there was a little bit of a scare that maybe it's coming back and 10-year yields are creeping higher, but that seems to have been slightly subdued.
Yeah, so in the next few months we are going to see higher inflation prints just because of the very low inflation last year, so you kind of get a base effect. But what markets are worried about more is that longer term dynamic. It is really interesting when you look at inflation pricing. It's now pricing more than 30 basis points higher in terms of future inflation expectations than it was at the end of 2019. And the end of 2019, we had US unemployment at 3.5%. And therefore you would have expected that's when you might see that enthusiasm and that belief in future inflation. But we are seeing it in markets, and it's something that for us, we will be leaning against. We don't believe this. We don't believe in a new normal for inflation. We believe there's a deep structural deflationary force at work in the background.
That's interesting. I was reading a part of a story this morning, John, from one of my colleagues, John Authors, that says robots won't save us from an age of inflation. But to some extent, I mean, a lot of people have argued that that increased use of technology has produced this low inflation environment we've existed under for many years, and perhaps badly understood. John, do you think we've really understood what's kept inflation as low as it has been over recent years?
No, I think we need to be so humble about it. I mean, investors and economists have systematically got inflation wrong. So since 2013, cumulative inflation surprises, so realized versus expected inflation, is minus 8%. And that's against a backdrop where there's been no disappointment in growth. Growth has, in aggregate, come in line over that period. So there is clearly something going on in the background. And I think investors and economists generally, the starting point should be, we need to accept we don't really understand inflation dynamics. And then we should be very careful using traditional frameworks to make suggestions about future inflation, because we need to accept those didn't really work. I think one of the issues is that the inflation print we all see is not the inflation people experience. So let's take tech as the ultimate example. If you play Fortnite, you may not pay a single penny to play that game. You can play it for 1,000 hours for free. Now, that means it doesn't appear anywhere because you haven't bought anything, but it's giving you a utility. It's giving you a kind of realized, experienced benefit,
for sure,
even if you're not paying for it. And then you've got things like, obviously, new generations of mobile phones. Those don't get properly allowed for. The quality improvement people experience. And then finally, you get things like when you move from Blockbuster to Love Film to Netflix, those are treated as different products, not as a massive deflationary force, because you're getting a much better product for the same price.
Good points, all of them. I mean, it's interesting. I think of the iPhone as expensive, but it doesn't cost more than the StarTAC, the Motorola StarTAC cost to the flip phone that you put on your belt 30 years ago, and it's so much better. Fortnite, I have to admit, having played thousands of hours, unfortunately, there was a period when I thought buying new skins would make me a better player, and so I spent $99 on that. It didn't actually work. Let me ask you about then Hillary could pull up any number of charts right now. Want to talk about central bank balance sheets? What happens when they start to build their balance sheets by trillions? The Treasury General account has climbed to $1.63 trillion. Fiscal stimulus has got to be in the double-digit trillions if you look at it globally, John. With all of this money being just printed and passed out, how does that not bring inflation? Because I can assure you, if you doubled the supply of Bitcoin overnight, the price of that would drop.
Yeah, so in money, the missing variable is velocity. So you can print loads and loads of money, but if the money you print just gets used less frequently, then actually that kind of avoids the inflationary problem. So what happened after the global financial crisis was that the volume of money went up a lot, but the velocity went through the floor, which was kind of what confounded investors and economists at the time. If you remember, kind of quantitative easing was supposed to be exceptionally inflationary. This could be the beginning of the US Weimar Republic, etc. And in fact, we got this deflationary impulse. So I think probably the new bit this time is the money on consumer balance sheets. So if you add up all of the money that's been given to consumers, currently it's about 7.5% of US GDP has been added to consumer balance sheets in excess savings. And when you add on the latest plans and the likely Biden plan for March, that gets you to around 10% of US GDP. And that may be the new bit, the idea that you've actually put money directly into people's pockets, not supercharging financial assets, but actually into people's pockets, could cause more spending. So I don't disagree with the growth angle. It's just this idea that when you get that growth, it will somehow create a sustained inflation, something we failed to create over the past decade that I struggle with, and we struggle with a lot more. That's why structurally we're more in the deflationary camp, despite the fact we buy into this idea that larger consumer balance sheets could be a driver for very, very strong shorter-term growth.
John, really good to speak to you. Certainly, we've seen some of those reflation trades perhaps put on pause then after we saw that data yesterday. So that's a really interesting conversation to have at this point. John Rowe, Legal and General Investment Management, Head of Multi-Asset Funds. He stays with us. We'll get further thoughts from John in a moment. Coming up on the programme, we'll turn our attention to Europe. Angela Merkel updates the Bundestag, getting live pictures of that coming through this morning. She's talking about the country's reopening plans. The German Chancellor lost a battle with state leaders over the pace of easing lockdowns, certainly on the timing of school reopenings. More on that next. This is Bloomberg.
welcome back to Bloomberg Markets. This is the European Open. We are 11 minutes into the session. We're looking at 0.1% gains. Really, as Anna said, kind of taking a breather from the reflation rally. Right now, Angela Merkel is speaking. I think we still have live pictures of her at the Bundestag. She has lost somewhat a battle with local leaders over the pace of easing the lockdown. The German chancellor proposes that schools and hairdressers could open as soon as this month after that discussion. I don't know why the emphasis on hairdressers. It's not like Germans are really that into hairdos, so to speak. And she could have picked any number of other businesses, like masseuses, for example, or what do you call when they do your fingernails and your toenails? Pedicurists. In any case, schools and hairdressers could open this month. Authorities have also set criteria for reopening non-essential stores, not as essential as hairdressers, from March 7th if the COVID outbreak continues to slow down. It really has slowed down drastically. We're almost down to 50 cases per 100,000. I think we're at 68 yesterday compared to 200 at the peak. So live pictures there of the German chancellor defending her plans at the Bundestag. But of course, her plans have been majorly influenced by state leaders. Anna?
Let's get back to John Rowe, Legal and General Investment Management Head of Multi-Asset Funds, who's still with us. John, Angela Merkel there talking about the reopening schedule for Germany. I'm thinking, of course, sitting here in London about the reopening schedule here in the UK as well, and many people all over the world are thinking about this. How is this factoring into your thinking? Because what I've found interesting has been the more we've vaccinated in the UK, the more concerned we become about other variants coming from other parts of the world, and it seems the more the borders close. I wonder if this changes our thinking about how we will be able to return to normal and when.
Yes, in the UK, of course, we're deeply scarred by this new variant that started in, we think, Kent, and has got this significantly higher transmittability rate. But that will actually become the dominant strain in Europe as well, either that or the South African. When you've got a new strain that has a higher infectiousness, then it will gradually take over and become a dominant strain. So Europe should really be bracing itself for the fact that it will be dealing with a more infectious virus very shortly. And actually the percentage of European cases that are one of the variants with a higher level, a higher R0, is rising. So from that perspective, they should be very, very careful. I actually think if they were to reopen in March, that would probably be a mistake. So our expectation would be that Europe needs to reopen around 2 months later than the US and the UK. And that's because it's been so much slower with the vaccinations. Around 20% of people in the UK have now had their first shot, around 12, 13% of the US. And it's just 3 or 4% across the European Union. So from that perspective, that would be the worry. I think it would be a policy mistake if they open too fast.
Well, she doesn't want to. As I said, she's kind of lost that battle to some extent. In fact, right now, she's saying that it's only a matter of time before the mutations gain the upper hand. You know, I think the RKI had said 6% of the German infections were the UK variant. Merkel has said, and she's a physicist, I think her husband's a chemist, so they're scientists. She thinks it's more like a fifth of German infections are the UK variant, which is you know, of course, spreads much worse than the China variant, although we're not allowed to call it the China variant, but we are calling the UK variant British. Let me ask you what you think about investing in UK assets, John, considering what you've seen from the EU performance in vaccinations. I mean, everyone was so excited when they came out with their recovery package, finally agreed to borrow and spend as a whole. But you can see that this giant bureaucracy just doesn't work when push comes to shove. Does that worry you?
Yeah, it does worry us, and it's surprising that. So in some ways, they've learned a lot from the global financial crisis. They were much quicker to get together and agree a fiscal package, and they've been a lot looser. No suggestion of austerity this time, of course, but it's still really noticeable how much larger the US package or the UK package has been in terms of the fiscal side. So Europe is going to come out of that without the same money on consumer balance sheets. It's going to be slower coming out of it because of the vaccination process. And so it doesn't paint a very pretty picture. So most of that is kind of recognised. I think if they do open in March, that would be a policy mistake. So what we are doing in Europe is we're recognising that while the outlook looks quite glum, and they will be later reopening, at least in a successful way, if we see success from the US and the UK, that will kind of drag Europe with it. People will realise it is possible, and you could start to see higher growth being priced into Europe. So what we're actually doing in Europe is we're short European credit, and that's because spreads are very, very tight. And there are some nasty scenarios out there where Europe reopens, doesn't get on top of this, has a smaller fiscal package, and just doesn't have the support for the assets that we do in other places. And then on the flip side, we're short bunds. And the reason for that is that with yields so low, we just don't feel they'll give us a lot, even in a bad scenario, because yields won't rally that much. Whereas actually in one of those better growth scenarios, we could actually see bund yields significantly higher, as we've seen in the last couple of weeks with them rising. So that's kind of how we're navigating Europe. In the UK, clearly it looks a lot better on the virus side, on the vaccine side, and so we're long pound, and again, short UK rates as we look for this reopening and this more positive growth outlook.
We're getting comments coming through from the Irish as well this morning. The Prime Minister there saying a high level of virus restrictions is likely until Easter. So that takes us into early April, doesn't it? John, thanks very much for your time this morning. We appreciate it. John Rowe, Legal and General Investment Management Head of Multi-Asset Funds. John will be continuing his conversation with Matt and I on Bloomberg Radio. That's at 9 a.m. UK time, so in around 43 minutes' time. Coming up here on Bloomberg TV, what is next for Royal Dutch Shell? We speak to the CEO, Ben van Beurden, about the oil major's latest strategy update, the energy transition conversation. That's next. This is Bloomberg.
Welcome back to Bloomberg Markets. This is the European Open. We are 20 minutes into trading right now, and we're looking at some drops for the energy sector, and you'll find out why we're showing you the energy sector here in just a moment. Down about 0.5% as the Stocks Europe 600 climbs about 0.1%. Banks are also down right now. You can see banks falling about 0.6%. of 1%. We've been talking with bank executives throughout the program. So let's get into energy right now. Shell says its oil production has already peaked. The company's latest strategy update outlines its long-term growth plan and path to achieving net zero emissions by 2050. Here to discuss that strategy is Ben van Beurden, the CEO of Royal Dutch Shell. Ben, thanks for coming back to the program, joining us again. Talk to me about what it means to you that your oil production has peaked, that your carbon emissions peaked the year before, I think in 2018, right?
Well, that's right, Matt. Thank you very much for having me on the program. Yeah, absolutely. We see indeed that we need to transition, which means that indeed we're going to put more emphasis on those parts of the energy system where we believe the future is. We're going to put more emphasis, therefore, also on working from the customer back, because we believe most of the opportunities in the energy transition, most of the value, if you like, is going to be serving customers as they need to find their way to net zero. So we have a whole set of plans that we're going to talk about today. We have a vision for 2050, but a pretty clear plan for the next decade, what it will take to indeed transition our company, not necessarily completely away from oil and gas, but definitely more towards these energy systems of the future.
And let's, good morning to you, Ben. Let's about the plans that lie ahead and the transition and where the future of the business is. I don't think you've increased the amount of money you're going to spend on renewables today. Does that remain at 2 to 3 billion a year? Why have you not given a new figure for that, or correct me if I've misunderstood?
No, good morning, Anna. And we believe the energy transition is not so much how much money you can put into assets that make sort of commodity green products. It is much more about how you serve customers as they need to transition. So the ambitions that we set and the sort of milestones that we are going to talk about today very much things like we will be serving 15 million customers with power, twice as much as we sell today, 50, 60 terawatt hours a year, which is roughly the same as Germany. We have 10% of low carbon fuels in the energy mix. We're going to increase the number of charge points from 60,000 today to 500,000 by the middle of the decade, and 2.5 million by the end of the decade. More hydrogen, double-digit market share. We are the leading player already, and helping customers with offsets as well as carbon capture as a service. So we believe the story of the future of energy is a story that is going to be told around creating value with customers, not by building assets that produce commodity green electricity.
So, you know, as I've said many times, I drive a lot and I seek out and fill up typically only at Shell stations, probably because of the V-Power brand, because of your link with Formula One, because of your link with MotoGP. How will you get electric cars to have the same kind of dedication, customer loyalty? Are you going to have a V-Power for charging stations? Are you going to have something that differentiates your brand from others when it comes to electric?
Yeah, well, first of all, Matt, thanks very much for that endorsement. And it doesn't surprise me, of course, because we do indeed have premium offerings. And quite often it is indeed the quality of the product and the quality of the service that makes you come to us. You come to fill up at a Shell service station, not because we have the best refineries, but we have the best products. Now, it's going to be the same thing, of course, with with power. It's going to be convenience. It's going to be the speed with which you can charge, but it's also going to be the experience of being in a charging station, a retail station. But not only that, it's going to be the convenience of being able to do it indeed on the move, at home, at your destination. It's going to be the integration of all of this in your daily life, be it with convenience activities like parcel collection or integrating it into your home systems, etc. And therefore, again, it's not that we have special electrons, it is we have special convenience, taking the hassle out of it and providing a highly valuable, convenient solution for customers. That's how we won with differentiated fuels. That's how we're going to win in the energy transition.
And Ben, let me ask you how you're doing at persuading investors to go along on this with you. I see this morning that the Church of England Fund and Rebecca have both welcomed the strategy that you've set out this morning, but not all your shareholders are maybe cut from the same cloth, and we saw that the moves around the were not well received by some investors previously. So how are you managing to keep all of these disparate groups, perhaps, of investors, if that's what they still are, together?
Well, that's a very good question, and there's a number of things that we have to get right. So, first of all, we have to make sure that as we transition in the future, that people really understand there is superior value to be harvested. And we're going to talk about that a lot today, that we are going to have a very disciplined approach, how we invest and how we access that, shall we say, value pool of the future. But at the same time, we're not going to immediately back on our legacy businesses. As a matter of fact, we're going to use our upstream business very much as a high-quality financial foundation of the company that is going to pay a significant part of share. That will help us serve customers. But we will continue to invest in upstream, in chemicals. Business probably with 30%. We will invest in LNG. We will grow our LNG business with 7 million tons per annum by the middle of the decade. So it's not as if we take an investment holiday, but it will be a much more balanced approach, and an approach indeed that goes to the more capital light side of the spectrum.
So you'll continue to, so the electric charging will be a focus. You're going to continue to grow your. What about hydrogen? Yesterday we talked a lot about the first hydrogen ETF. Is that a fuel that you're going to continue to provide more and more of?
Absolutely, Matt. I think we can claim that we are a leading player, if not when it comes to hydrogen for mobility. But of course, it is a minuscule market at the moment. We've been working at it for about 25 years, but it hasn't really taken off yet. We think it is at the inflection point where it will take off, and where indeed hydrogen for heavy goods, maybe also hydrogen for shipping, hydrogen playing a role later on in aviation, is going to be something very significant. And again, I think we are well placed. We again have a massive footprint when it comes to serving heavy duty goods vehicles. I think we have a really good position to integrate hydrogen in our growing power positions. We're going to talk about it a little bit more today as well. And we believe that in the end, the hydrogen business has similar characteristics as the LNG business. And we are the leading player in LNG, and we want to basically replicate some of that journey for hydrogen, initially at a small, but eventually a business that can rival our LNG business.
Ben, we're talking about various different energy assets. Let me ask you about wind, offshore wind. Do you think that is still competitive, or is that not a focus?
No, it is a very important component in our portfolio. As a matter of fact, we are, of course, starting up at this point in time another large wind farm in the North Sea. We are constructing another large wind farm in the North Sea as we speak. And that wind farm, by the way, major customers, anchor customers like Amazon. It may also serve some of our own demand, but it may also serve, for instance, building out that hydrogen structure that we were just. But we believe that investing in wind farms just to provide electricity into a commodity market with merchant pricing mechanisms is not the recipe for success. You have to look at the integrated value of electricity into the end. That's how you get to compelling returns that we are going to talk about today.
Ben, thank you very much. Thanks for coming to talk to us. Good luck with the day ahead. Ben van Beurden, Royal Dutch Shell's CEO. Coming up on the programme, an existential threat. That's what one of Britain's largest business groups says faces many small firms as they grapple with Brexit trade obstacles. We details next. This is Bloomberg.
pretty good. I'm getting a new motorcycle today, although the weather's not ideal.
No, not much good in the snow.
I bet I
special
see.
tyres, Matt.
Yeah, no, it's pretty dangerous in the snow. There are no snow tires for motorcycles.
Mm-hmm. Welcome back to the European Market Open. 36 minutes into your European trading session, and European equities then making some modest moves to the upside has been the story of the morning, up by around 0.2%. The CAC 40 underperforms a little bit over in Paris. If we have a look at the sector breakdown, broadly speaking, the market readjusting or taking a pause to think about what we learned about inflation yesterday, both from the data side in the CPI and also from Jerome Powell and what he had to say about inflation and the extent to which they want to see actual inflation before doing much. We've got the sector breakdown looks like this: technology to the upside, healthcare, utilities also moving higher. So it's not an entirely risk-on look at the movers, if you like, or of the sector breakdown. And to the downside, real estate and banks moving a little bit lower. We've had plenty of corporate earnings out this morning as well. Now, many UK small firms are facing a, quote, existential threat as they grapple with obstacles that Brexit has imposed on trade with the EU. That's according to one of Britain's largest business groups. In a survey of 465 firms, the British Chambers of Commerce found about half of UK exporters are experiencing difficulties, mainly in the form of extra documentation, higher costs and delays to shipments. Joining us now is Hannah Essex, BCC Co-Executive Director. Hannah, good morning. Great to speak to you. Thanks for coming to talk to us. One of the comments from one of the exporters that you talked to in your survey really struck me as interesting. They said there is such a long way to go before we fully understand what the new normal is. And I suppose that is part of the problem. There are the difficulties that are well documented and that you've documented here that we all know about. But getting to grips with the full extent of what has changed takes a long time.
That's absolutely right. So, you know, the deal was done. We were supposed to have this transition period, but the deal was done at the very last minute. So all of the transition is happening right now while the changes have come into place. And while there are some easements around certain procedures or certain elements.
Good morning, guys. I'm going to place an order to sell. So it will be stop order for Canadian dollar. As you remember, we still hold short position on Canadian dollar, and right now I'm going to stop. I want to sell by order, and I want to place stop on profit. The price I'm looking 126.885. Okay. That's it. We placed an order. So if you follow the trades and if you order specifically this order, you need to place the order to sell your position. Speak to you later.
Businesses have sort of deliberately avoided January and used stockpiling to avoid that because they knew that there were going to be some issues around it. But you have to remember all of the drama, all of the stop-starts, is it a no deal, is it not, that we had in 2018, 2019, where some businesses spent money preparing for something that never happened. And last year, because of the pandemic and because of what had happened before, businesses had neither the cash nor the confidence to put in place massive contingency plans. And so until the deal was actually published and until the guidance actually came out to businesses, which was at the very last minute, they didn't 100% know what was coming, and some of the decisions hadn't yet been made. So there is going to be this time that businesses need to adapt. But it's not just about understanding the rules, it's about deciding whether or not the changes make it viable for you to continue to operate in the way that you do and what you're going to need to do to adapt.
All right. Hannah, thanks very much for joining us. Hannah Essex is the BCC Co-Executive Director, talking to us about the changes that have come about as a result of Brexit. Coming up, we're going to speak to the French Transport Minister about the impact of the pandemic on the travel industry. Don't miss that interview next. This is Bloomberg.
I'm going to move a little bit further. My stop on profit to 126.875. So if you hold position, if you follow my trades from yesterday, this is what you have to do. Okay?
Welcome back to the European Open. We are 44 minutes into the cash trade right now and looking at a stocks Europe 600 that is rising, although you can see that energy and banks are down after trading updates and earnings reports out today. The coronavirus pandemic and lockdowns have massively impacted European travel, obviously. With countries across the region rolling out vaccine programs, focus is now turning to the summer holiday season. Joining us now to talk more about how the EU is going to deal with that is Maria Tadeo with the guests. Maria?
That's right, Matt. Good morning. And we are joined by the French Minister for Transport, Jean-Baptiste Djebbari. He is a pilot by training, so you know that's handy when you're a Minister for Transport. And, sir, you know, when you look at the situation, I want to be very specific to kick off with Air France, KLM, just because I know that you've said many times you look at this as a very strategic asset for your country. We know right now you want to inject cash in the company, but the European Commission is saying not so fast. You have to give up slots in the Paris-Orly airport. Is that something that Air France should contemplate, to give up the slots for money?
Well, good morning to you. The thing is, we loaned Air France KLM with the Dutch counterpart about 10 billion last year to just ensure its capability to survive and face its charging during the peakest time of the crisis. And now, obviously, as you said, we were in the discussion with the Commission to recapitalize the group Air France KLM. Air France is still losing about 10 million a day, which is obviously massive, because the traffic is still very low. And at the same time, the company is getting under huge transformation, cutting about 17% of its workforce. And it's a massive effort from everyone here. So obviously, we want competition. We want fair competition. But what I'm saying to the Commission as well is during the last 10 years, we did not regulate the aviation sector on the social point of view. And we still have some low-cost carriers that are very well positioned on the recovery of after the COVID era, so to say. And we still have some very weird situation where pilots pay to fly, where we have airlines that are currently using independent workers instead of getting them employees. And that is consistently distorting the market. So what I'm saying to the Commission is we want competition, but we want fair competition. So if we are talking about this package for Air France KLM and the commercial remedies, we need to approach this in a wider angle.
Okay, and you make it clear this is about competition, but based on what you're telling me, the slots, the idea that Air France should give them up to some extent is something that you would not contemplate at this point. And if you don't contemplate that, then what is a compromise looking like? Is it about rotating perhaps the slots or canceling some of those slots?
You know, there is the technicalities and there is the principle. The principle is we want something proportionate. And we can't compare Frankfurt to Paris, for example, and we can't compare Orly to Charles de Gaulle. We need something proportionate that addresses the reality of the market and the reality of the French aviation operations. At the moment, we are not quite there. So we want things to be proportionate, and we want to address not only the competition, but the social aspect of the aviation sector.
Okay, and when do you see a compromise with the Commission? And the reason why I'm asking, there's a lot of investors that are hoping this is happening in the next few weeks, especially because we know the company is reporting earnings next week. Can we get something done in the next few days?
Well, there are some ongoing discussion. Obviously, we are working with my colleague Bruno Le Maire on that matter. We have constant discussion with the European Commission. We will see where things can be pursued on that matter. But obviously, we have ongoing discussion at the moment with the Commission.
And in terms of the overall package that is going to Air France KLM, there's a lot of numbers that have been floated around. And, you know, we've heard things like perhaps it's another 3 billion, perhaps it's closer to 4. What number are we looking like? I know you can't give the specifics, but what's a region?
No, but the figures that you approach, well, we are talking about billions, and you know that last year we lent Air France 7 billions. The Dutch government made a loan of 3 billions as well. So we are in that. I mean, the aviation sector is deeply harmed, as you know. We had 66% of decrease in the air traffic last year, and because of the restrictions that were applied by the European countries, especially France, 15 days ago now, we still have some very low air traffic, and we do not expect recovery within the next full months, and we expect full recovery within the next 2 or 3 years. So obviously, the aviation sector will remain harmed by the COVID. So obviously, we are talking big numbers.
And you're talking big numbers, and assuming, again, I don't want to put words in your mouth, but, you know, if we look something close to 3-4 billion euros extra, there's also a Dutch component here. They also have to pay into this company. They have an election coming up in March. A lot of analysts say that the governance is also a problem because there's tensions between your government and the Dutch government. When do you think the full package can come to fruition, including their bid?
Well, I mean, as you said, there are some elections going. They will have to form a coalition afterwards. We know that it always takes some time, obviously. So we are discussing on a daily basis with the Dutch government regarding Air France KLM. What I want to say is we are very clear since the beginning. We want to save our national companies. There are systemic companies for the aviation sector, so we will save them. And then the technicalities with the Commission, the technicalities with the Dutch government, the possibilities politically for them, we take that into account, obviously. And we are trying to engineer the whole package given those constraints.
Right. And Minister, just very quickly on the Eurostar, you know, a lot of people that watch Bloomberg care about the Eurostar. They do London, Paris on a very frequent basis. Do you foresee any French money going into Eurostar to keep it going?
Well, we put some money with the British side a few months back now, about 400 million pounds a few months back, and the Eurostar benefited from the French tourism plan, for example. We are discussing with Grant Shapps, the British minister, regarding the recovery plan for the Eurostar. It's obviously a very strategic link between our two countries, and I told Grant Shapps that it's very important that Eurostar, which is a UK-based company, it's very key that the UK government takes its fair bit, but the French government will be there as well through SNCF. That is, as you know, the major shareholder of Eurostar.
It is. Well, that's a clear message from you on the UK government related to the Eurostar. Well, thank you so much, Minister, for joining us. We appreciate your time here on Bloomberg Television. And that was the French Transport Minister, Jean-Baptiste Djebbari, joining us from Paris today. Anna?
Maria, thanks very much. Bloomberg's Maria Tadeo with that interview. We'll take a short break. This is Bloomberg.
position closed on Canadian dollar. Let me show where. Close it just right here. So great, well done. You made a profit. Okay.
Bit of inflation trade going on, but the inflation element of that is still a little bit missing. So perhaps this is still really all about central bank pushing more money into the economy. That's what I think.
It's still all about that. What about commodities then, Eddie? We've been tracking the rise of the oil price. It's not just the oil price that's been on the rise, though. Some other commodities doing pretty well, but far from those 2011 levels on the Bloomberg Commodity Index.
I think there's definitely so oil is definitely hoping for a reopening later in the year. There's still a lot of optimism there. OPEC doing its best to keep prices, supported, and that's doing well. But copper and the other commodities doing well on China's recovery, so that's helping.
Why is gold only at 1842, Eddie, when we're talking about multi-trillion-dollar spending plans by all Western governments and central bank balance sheets that are just continuing to rise?
Yeah, gold's looking forward here. Gold's looking at. I think a lot of people in the gold markets remember 2008 and the fallout of that. And it's not so for gold. It's not so much about the money being pumped in now. It's the fear that at some point we're going to see. Tapering talk and all that sort of stuff. But we're also going into Chinese New Year, the Lunar New Year, Year of the Ox, and that is traditionally the period after that's very weak for gold. So I think that's
we'll keep an eye on that.
All weighing. Thank you.
Yes, absolutely, and Happy New Year to those celebrating that Lunar New Year. Eddie, thank you very much for that important reminder. Markets Live editor Eddie van der Walt joining us with a look at these markets. As we see European equity markets then making pretty modest gains to the upside. US futures point higher, up by around 3 or 4/10% this hour. Matt and I are off the Bloomberg Radio. Surveillance is up next here on Bloomberg TV. This is Bloomberg. Great.
I think the glasses would have been nice without this little black number. Hi, Sarah. Yeah, I can hear you great. Great, thank you.
it is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Commerzbank is posting its biggest quarterly loss in more than a decade and warning that revenue will shrink this year. That says CEO Manfred Knof ditches a failed growth strategy in favor of deep cost cuts. Commerzbank is shedding about a third of its German workforce and closing almost half of its retail branches. Now Shell says its crude production has entered a long period of decline. The oil major sees it falling by 1 to 2% a year, with output of traditional fuels about 55% lower by 2030. Shell is laying out a detailed plan for a transition to cleaner energy, including new targets for electric cars and carbon capture. And UniCredit has posted an unexpectedly large loss for the fourth quarter. The final results under Chief Executive Jean-Pierre Mustier. The loss came due to added costs and an accelerated attempt to clean up the lender's balance sheet. Incoming boss Andrea Orchel inherits a leaner bank but still faces a slew of challenges. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now let's keep it on earnings season. Still with us, James Bevan from CCLA Investment Management. James, I have a million questions on a million industries. First of all, is there an industry that we're getting wrong that you like and few other people do?
Well, I still look at technology and healthcare, which a lot of people have determined have had their day. But I look at the resilience of the earnings numbers and the price that we should reasonably be prepared to participate in those earnings numbers. And I still see value, and I'm not going to let go of the good quality names that I think that on a rolling 5-year view will positively deliver the free cash flow that's necessary to justify firm valuations.
James, where do you see as the biggest shift? I know there's a shortage of chips, for example, in the U.S., and we're talking about whether that can drive inflation. But is there more a technology story on individual components that we could be lacking of in longer term?
For me, the big story is about why and how the U.S. has to re-engineer its economy to deliver faster economic growth. The trend growth that was in place since the global financial crisis was around 2 percentage points. I would observe that we are considering a trend rate of growth now in the States of around 3% on the back of productivity improvements. And those productivity improvements will come from the application of smart technologies. The Internet of Things is clearly going to be a significant driver. And as wages increase in the States, I think we can square the circle between the requirement to keep inflation reasonably low and deliver strong economic growth if we see technology being taken up in supply chains. And that, to me, is therefore the focus that we have to have technology. Where is the technology going to be placed within supply chains?
But James, what do you make of the earnings season? So the earnings season seems, in many cases quite positive with, I guess, a bit of wobbles here and there. But there's a presumption that once there's a vaccine rollout, everything is okay. Do you have questions about the validity of that?
Well, I would make two observations. First off, the year-on-year comparisons for companies that fell into the slough of despond on the back of the COVID-19 crisis are clearly going to look extraordinary. And we know that if you decline by 50%, you have to see a 100% increase to get back to where you started. The big question for me is, what will the rate of progress be once recovery has been fully in place? I'm expecting around $177 of earnings for the S&P 500 for the end of this year. That would compare with about $169 at the end of 2019. So the 2-year progress of earnings isn't going to be that much. So the big question is, what are we going to see in 2022? Now, I think that if it is correct, the productivity improves, we could see up to $190 in 2022. That would allow one to be optimistic about the prospects for equities. But any earnings shortfall in 2022, I think is going to be punished hard because valuations are rich.
James, where do you stand on inflation? What if inflation were really to shoot up? Actually, central banks don't really, run through it. Are industries all made equal, or do some get clobbered?
I find the inflation story absolutely fascinating because the devil is most certainly in the detail. When one lifts the lid on the supply chain inflation in the States, it's quite clear that there's a lot of inflation working through the system, but it has not, as we all know, ended up at the consumer price index level. And I would say, therefore, we should expect there to be a margin squeeze in companies that are relatively low quality, cannot control the prices of their inputs or their outputs. And for me, therefore, quality, which has been an absolute dog in terms of stock market performance for the last month, is going to have a resurgence later this year as people recognize the real importance of investing in companies that have some control over pricing.
What do you do in China? Are you long China?
Yeah. Frankly, I find China extraordinary. It is clearly an engine of exceptional growth. I look at companies like Tencent and I see an enormous reservoir of value, but I have real reservations about China's human rights record, its lack of commitment to the eradication of modern slavery. And indeed, when I think about how China is behaving with its minorities, I anticipate that Mr. Biden is going to be tough. He will talk tough and then he will deliver tough. And the risk is that he not only says to US companies that they need to reorganize their supply chains to deal with the modern slavery challenge, but he moves from the tariffs on trade that Mr. Trump favors to a focus on the capital account, and a reduction in credit and liquidity, the availability of dollars to China could signal a real challenge for China's economic growth.
James, thank you so much. James Bevan there, Chief Investment Officer at CCLA Investment Management. Now, coming up, green energy remains, of course, the hot topic for 2021. We hear from the Chief Executive of General Motors about the automaker's push into EVs. That's up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. General Motors beat the street with the fourth quarter profit and signaled continued earnings strength this year, despite short-term damage from a semiconductor shortage that is cascading through the auto industry. The chief executive, Mary Barra, says margins on EVs likely won't reach parity with the gasoline-powered cars until the mid or later part of the decade.
We're going to have a very positive year in 2021, not only from a financial perspective, but also the continued acceleration of our EV and our AV business. We're really excited that very shortly we're going to be launching the Chevrolet Bolt EUV, which is a great vehicle, and that's days away. And then, later this year, we'll be serving the market with the GMC Hummer EV, and then the Cadillac Lyriq comes shortly after that, as well as tremendous progress being made from an autonomous perspective as well. So we're really excited about the year, the growth opportunities that we have in front of us. And so it's a year of execution, and the issues with chips, this is a short-term issue, and we'll work through it.
Well, is General Motors basically in the same boat as everyone else, or are there things that you can do to get something of an advantage over other automakers?
Well, I think in general, this is an industry issue. Of course, we're working every single day with a cross-functional team to look for opportunities of how do we minimize the impact. So we'll continue to do that. We did provide the guidance with a fairly wide range, and we'll work it every day and provide updates as we go forward.
Mary, as you said, you've got a lot of EV models coming out, including, as you say, the Bolt EUV and the Bolt EV new model coming out. You're investing $27 billion. This is part of a multi-year plan here. As a practical matter, what are the difficulties in that plan? And particularly, I want to talk about supply chains, things like battery cells, some of the lithium issues. Do you anticipate possible problems with supply chains into your battery operation?
Well, I think, we're one of only two automakers that are doing cell manufacture in this country. We also are doing a tremendous amount of development on our own and our own GM R&D, as well as partnering with startups and, of course, our joint venture with LG Chem that is development as well as production. So, we're working hard to make sure we have all the cells we need, and we've worked, through the supply base to make sure we do, because we are, as we've talked about, we're accelerating our EVs with 30 by 2025, and really covering the whole market. So we continue to work it, but we think we've got a very strong plan.
Well, that was General Motors Chief Executive Mary Barra speaking with Bloomberg's David Weston. Now, coming up, we talk a lot more about private equity as company valuations continue to push higher. What does 2021 hold for the private equity industry? We'll be talking to William Jackson, managing partner at Bridgepoint, which has 26 billion euros of funds under management. That's coming up next, and this is Bloomberg.
another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Germany is on course for a looser lockdown as schools and daycare may reopen as soon as next week. It's a win for state leaders over Chancellor Angela Merkel, who wanted to extend the curbs and maintain consistent rules across the entire country. Other restrictions that were due to expire on February the 14th will now not last until March the 7th. The UK is setting a target to vaccinate all over 50s by the end of April, but Prime Minister Boris Johnson is warning it's too soon to talk about lifting the nation's lockdown. Experts say more data on the success of vaccines is needed before restrictions can be eased. The Prime Minister told people not to book any summer holidays just yet. And the US is imposing sanctions on military leaders in Myanmar following a coup. It will deprive the army chiefs of approximately $1 billion of assets held in America. The news comes as de facto leader Aung San Suu Kyi is still in detention amid protests across the country. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, after a slowdown in deal-making industry, private equity activity has come roaring back. The sector has begun to snap up companies in record numbers, even as the coronavirus pandemic triggered a global recession. Now, in a moment, we'll be speaking to Bridgepoint, but first, let's get more with our Danny Berger. Danny, is it that actually private equity has done great, worldwide, or are there specific companies that have done best in certain regions?
Well, look, the activity for sure is global. In terms of global volumes, we've seen in the fourth quarter, it bounced back nearly $500 billion worth of deals done. But looking at sort of the specifics, you look at things like tech. Despite the pandemic, we've seen tech valuations for a lot of these deals remained extremely rich. Of course, that's because they're somewhat immune to the pandemic. Other places of activity, the UK has been extremely active. Much of that has to do with the March 3rd budget coming from Rishi Sunak. There's a thought there that the capital gains tax might be changed, so a lot of businesses being sold before they possibly face that. But across the board, part of the reason deal activity looks so strong is more or less making up for lost time. At the beginning of the pandemic, we saw a lot of private equity and generally deal activity slow down, perhaps people trying to get used to a new virtual world where you can't do deal origination in person. So what does that look like? That looks like numbers we got from KKR from their earnings this week, a record $12.5 billion deployed in the fourth quarter, and they were also able to raise a record $44 billion in 2020.
Danny, thank you so much for the hugely beneficial roundup. Now, to talk more about private equity, we're joined by William Jackson. He's managing partner at private equity firm Bridgepoint. The company, of course, operates from 11 offices around the world and has 26 billion euros of funds under management. William, thank you again for joining us on Surveillance. When you look at how much private equity has been doing, and it's been doing quite a lot, do you see that momentum continuing, into 2022? And what does that mean for valuations?
Well, I think this has been a market which is incredibly suited to private equity. I mean, there's a huge demand for capital out there, and the nature of the model of quick decision making, of rapid connection between shareholder and management is absolutely perfect. So it's been a strong period for the industry.
When you look, William, at some of the things that, you know, we follow right here on Bloomberg almost day in, day out, will LBOs become even bigger?
I think they will. You know, I mean, there's a huge debate going on amongst both those of us who do the investing activity and our own investors over value versus growth, as we were just hearing in the introduction there. You know, the continued rise in the valuation of growth has been phenomenal, and this pandemic has been very polarizing across sectors. And I think people are starting to stand back and saying, are these valuations just too high? And is the better value out there in sectors that have been hit by COVID? And a lot of that depends on what's going to happen with the vaccines. So this is a really interesting moment for the industry.
William, Danny here. So how do you view then those more beaten up sectors? Would you be interested, for example, in buying more retail or consumer focused companies?
Well, I think it comes down, this is going to be a really fascinating 3 or 4 months because, you know, you're just starting to see these vaccines rolled out. Nobody quite knows yet, you know, are they going to be fully effective, partially effective? How are they going to deal with the new variants? And this is going to have a really fundamental impact on valuations across sectors. I think there will be some kind of rebalancing during 2021 and into 22 on those valuations. And part of this is when you look at some of the tech valuations, these are businesses that on the whole are performing extremely well, but the rise in return from those assets is coming from valuation multiple uplift as much as earnings growth. And I think that is going to start to make people a little bit more nervous. So as we get clarity on the impact of the vaccines, I think you're going to see people just look at which are going to be the interesting sectors outside some of those core areas as well.
What do you do in the meantime then? How do you make sure that you're not overpaying for any of the companies?
Well, I think we're looking at, we look both at those growth sectors. And, you know, these are the trends that we've seen in the last 12 months are a massive acceleration of existing underlying trends. It's just brought forward probably 10 years of impact into some of those sectors. So those trends themselves are not going to reverse. I'm a firm believer of that. So, you know, there's still pretty attractive assets to acquire in the tech sectors, and it will be very vibrant through this year. But when you look at what is going to happen as
Yeah. William, how do you explain actually the growing interest in private equity and sports franchises?
Well, this isn't new, Francine. It's you know, people have been investing from the private equity world into sport for a long time. Bridgepoint, as you know, is another great firm, used to own Formula One. The attraction of sport is rather like news, actually. You know, it is best watched live. In fact, if you watch sport on a recording, it's pretty dull. So you get this huge amount of content with sport, and of course, content is very valuable. But investing in sport is not easy because, you know, to make a good investment, you have to have a great sport, and the sport has to come way ahead of the finances. And at the end of the day, you know, you as a shareholder, you may own the certificate, the share certificate, but the sport is owned by the fans.
Yeah. Do you know how actually sports is consumed in the Lacqua household, William? So usually, you know, the match is watched live, then it's discussed with family members, and then I think my husband also re-watches this late at night. I'm not exactly sure what's going on, but it certainly takes a whole day for only one match.
There you go. But the reason why it's on the agenda right now is that a lot of these franchises need capital, having had big revenue hits in the last 12 months. So that's why it's right in the public eye.
William, can I just ask about jurisdictions, and are there any that you would consider more friendly for peer-to-peer?
For private equity investing, I think all the European markets are strong locations in which to invest in, and I think if somebody has a private equity program, they want a decent exposure to Europe and the US, really, and Asia. Although the returns in Asia have definitely been better on the whole in the stock markets.
William, another phenomenon we're seeing in the stock market, of course, is SPACs. I mean, people who you would not associate with these types of things, be it Colin Kaepernick or Tidjane Thiam. What does it tell you that people who aren't really in the industry are getting involved in private equity-like instruments? What does that tell you about where we are in the market right now?
Well, it probably tells you that we're close to the top, doesn't it? I mean, SPACs are really interesting, and it's difficult to comment from London on this because we haven't seen many in London. But I mean, on the one hand, they provide access to companies at an earlier stage, and they give companies access to liquidity on markets earlier. But of course, they're doing that at the expense of the normal scrutiny that you'd expect with an IPO process. I think buyers need to be quite careful. There are some SPACs run by really professional investors. KKR has a SPAC. Hamilton Lane, another good firm, has a SPAC, and they're well placed to run those organizations. But when you start to see sports stars raising SPACs and so on, I mean, I think there was a quote in the New York Times this week saying that the writer knew more people that had SPACs than had COVID. It tells you something.
It certainly does. William, thank you so much. William Jackson, their managing partner at Bridgepoint, and also our Danny Berger. Now, coming up, with Brent crude gaining some 18% so far this year, we're next for the oil market. Well, our interview with the International Energy Agency is coming up shortly, and this is Bloomberg.
Ladies and gentlemen, again, if you're looking to buy Canadian dollar, we have placed an order to buy at 126.845. Let me show where. Just right here. So if you're looking to buy Canadian dollar, And if you follow our trades, you need to buy it. Okay, position opened at 126.845. It's a long position.
Of its German workforce and closing almost half of its retail branches.
Because we now have the benefit that we basically have booked already 50% of the restructuring costs of our transformation program.
Westfield owner Unibail is scrapping its dividends until 2023. The mall giant only plans to resume the payouts when its current debt reduction plan is completed. That includes about 4 billion euros of European asset sales and strict controls on spending. Its malls saw an average of just 70 normal trading days, and that was last year. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now, the rebalancing of global oil markets remains fragile amid a weaker outlook for demand and recovery in supplies. That's the headline from the latest report from the International Energy Agency, just published within the last hour. Now, we'll be talking to the IEA shortly, but first, let's hear from the chief executive of Shell. Ben van Beurden told us the company will use oil revenue to help fund the energy transition.
We're not going to immediately turn our back on our legacy businesses. As a matter of fact, we're going to use our upstream business very much as a high-quality financial foundation of the company that is going to pay a very significant part of shareholder distributions well into the next decade. It is a balanced narrative based on a very disciplined approach that we will be laying out today. Disciplined in cash management, disciplined in carbon management.
Now, to talk about oil demand in the oil markets, we're now joined by Toriel Bozzoni, head of the oil market division at the IEA. Toriel, thank you so much.
Euro. We're looking to buy euro, so we need to place an order. Buy euro at 121.27, but I think it's too late. Let's see. Let's wait for a couple of minutes. 121.27. This is where I want to buy, and unfortunately, as you can see, we didn't have a chance to get position. Okay, let's wait for another time.
And oil demand during 2021 is looking brighter despite the near-term weakness because of the coronavirus, the new cases, the new variants that are coming, and mobility restrictions and travel that remains very weak.
Toriel, if you look at the differences in terms of fuel demand and how that compares with refinery runs, so it's different in Europe that it is in the U.S. What does that actually point to?
I'm sorry, could you repeat the question, please?
So, Toriel, when you look at some of the fuel demand in Europe, I think it's rising. Yeah, can you hear me now, Toriel?
Yes, oil demand in Europe is remaining particularly weak at the moment because of the restrictions that we have on mobility, on travel, lockdowns in many countries, a slow rollout of the vaccines, number of new cases, lockdowns in many countries, seeing that the recovery in Europe is lagging in other places in the world. U.S., we're seeing that refinery demand is picking up, very strong growth in the Asian countries, which of course led by China, who was the first into the lockdown and the first out of it. We're seeing very strong growth from Asia, but also some weakness currently there as the number of cases are rising.
Yeah, so basically, if you look at fuel demands, and I have a great chart here which we'll show in a second. If you look at fuel demand in Europe, it's recovering much more quickly than refinery runs in 2021. Is that because of the way that refiners are reacting, or is there something a little bit more symptomatic that we should look at?
Yes. So in terms of refinery demand and in terms of oil demand, during 2020, a lot of the overhang that built up in inventories was in refined product, as opposed to crude. Now we're seeing that the refiners were slower to react to the collapse in demand that came about in early 2020. So they built up a lot of inventories of stocks of gasoline, of diesel, and especially jet fuels that has to be drawn down. So margins remain weak for refiners. We'll continue to draw down the inventories for the margins and profitability for refiners to improve. But we're seeing now the stock draws globally are being led by product inventories. Refinery runs expected to increase, but we still have to reduce the overhang on the product stocks that built up.
Toral, how do you see
of course,
the U.S.
and for the refineries,
Toral, how do you see the U.S.-China relationship actually impacting demand for oil?
The relationship between U.S. and China, of course, now we're seeing increased exports of U.S. oil to China. The economic recovery and oil demand recovery is first and foremost being led by China and other Asian countries at the moment. So we're seeing that as the trade situation between the two countries normalize, increased imports from the U.S. to China, exports from China to the U.S. will support the U.S. economic recovery and vice versa, which is both supportive for oil demand growth later this year, especially in the second half of the year.
Toral, thank you. Toral Bozzoni there, head of oil market division at the IEA. Now, coming up, Germany prepares to ease some curbs in its long lockdown. The decision comes after a battle of wills between Merkel and regional leaders. We have that story next. This is Bloomberg.
Climate change is the defining issue of our time, so we've redefined how we cover it. With clear data and rigorous journalism, we rise to the scale of the challenge to reveal the breadth of possibility. We look at stories from every angle to provoke debate, spotlight solutions, and make sense of the greatest crisis of our generation. Bloomberg Green, solutions for a changing climate.
It is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Now let's get straight to the latest on the lockdowns here in Europe. Germany mapping out a path to reviving Europe's largest economy, with children returning to school as soon as this month in certain states. Well, the Chancellor presenting the plan to Parliament today, but also issued a stark warning on the danger posed by virus mutations. Well, joining us now is Bloomberg's Western Europe managing editor, Chad Thomas. He's also our editor-in-chief for Virology Watch across Europe. Chad, there's so much going on, and really it's every state for itself. Chancellor Merkel has been much more cautious about reopening in Germany than other countries. Why?
Well, hi, Francine. Chancellor Merkel, of course, is at her core a scientist. She's a scientist by training, and she says that she's very concerned about virus mutations taking hold here in Germany. They've already seen some of it here. And she, therefore, has really pushed to keep this country locked down. The lockdown now is going to extend for many parts of the economy into March. As you said, schools in some states will start reopening as early as next week. And they are coming forward with a plan to start to reopen things like hairdressers in March as well. But really, many things are going to remain locked down here in this country for the foreseeable future.
How are vaccinations going? I mean, this, probably was the biggest spat between the UK and the EU, certainly after Brexit.
Yeah, and that is the thing that also I think is weighing on Chancellor Merkel in saying that she wants to continue the lockdown here. Germany is at about 4 vaccinations per 100 people. That's, of course, way below the UK rate of around 20, and also the US. And so until they can get that really rolling, I think you're going to see the lockdowns continue here to some degree. The Chancellor has promised that everybody in Germany who wants to get a vaccination will get one by the middle of September, but that many of those vaccinations will probably taking place sometime over the summer.
Chad, thank you so much for joining us. Bloomberg's Western Europe managing editor. He is, of course, Chad Thomas. Now, Bloomberg surveillance continues the next hour. Tom Keene joins me out of New York. We'll talk about the markets. We'll talk about some of the reopenings. And then we have quite a lot of earnings out there. I know Brexit news also creeping up back on the agenda, with the UK offering to change the terms with the EU, and the EU said not for now. This is Bloomberg.
another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
Joe Biden holds his first call with President Xi as U.S. president. He raises concern over coercive and unfair economic practices. Tame U.S. inflation adds to the debate over price pressures. Jay Powell turns his focus to the labor market, calling for a society-wide push for jobs. And the EU rebuffs the UK's call to reset the post-Brexit relationship. It says Britain needs to honor the promises it made on Northern Ireland. Well, good morning, everyone, and welcome to Bloomberg Surveillance. Tom and Francine from London and New York. Tom, we need to speak about market movement, and you alerted me to it, and I just saw it, the U.S. two-year bond yield briefly printing a record low of 0.0972%. This is a hugely significant deal. Of course, this comes as cash trading, it's getting underway, and you just wonder what comes next.
It dovetails with the headlines that are just out. Before we get to the chart of this momentous moment for the U.S. two-year, let us go to the EU headlines. Francine, my first glance at these is again like the two-year yield. They signal a institutional bet on disinflation. They don't mince any words. They look for 18 months, 24 months of a quiescence in inflation.
Yes, Tom. This goes back to the fact that actually the last time the EU came up with forecasts, there was a, I guess, more optimistic picture about when we could get out of lockdowns. Remember, after, December, where people thought that we'd return a little bit more to normal in terms of going out and actually businesses open in Europe, we had a second and bigger wave of lockdowns. Angela Merkel has not been able to reopen the economy as she wanted, and that's, I think, really reflected in these EU figures. 2021 euro area GDP growth forecast 3.8% instead of 4.2%. But we'll talk a lot more about, of course, euro area GDP and also the relationship between the UK and the EU. Coming up shortly, our Maria Tadeo in conversation with Michel Barnier, the former EU chief Brexit negotiator. But first, let's get straight to the Bloomberg First Word News. Here's Ritika Gupta. Hi, Ritika.
Morning, Francine. Tom. House Democrats are building a case against Donald Trump using his own words, and a chilling new video of the storming of the U.S. Capitol and lawmakers escape. They laid out their case during opening arguments of the impeachment trial in the Senate. One of the arguments, that the former president tried to sow doubt about the election results months beforehand. Joe Biden raised a number of concerns in his first phone call as president with China's leader Xi Jinping. According to a White House account, the president spoke with Xi about what was called China's coercive and unfair economic practices. He also brought up human rights abuses and restrictions on political freedom in Hong Kong. And the European Union has rebuffed the UK's call to reset their post-Brexit relationship. The bloc says that the British need to honour the promises it made on Northern Ireland as part of the divorce deal. The UK has asked the EU to delay the implementation of border checks on some goods entering the province. And in Japan, former Prime Minister Yoshiro Mori reportedly will resign as head of the Tokyo Olympic Organizing Committee following remarks that demeaned women. That's according to TV Asahi. There has been growing criticism over Mori's comments that adding women to the board of the committee would lead to more talking. Global News 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Tom.
Ritika, thanks so much. A lot of moving parts right now. Let's get to the data. The data's, actually pretty quiet. Equities lift up this forever bull market after the Tesla Bitcoin pullback yesterday afternoon. Futures up 13. The VIX 21.70 just won't reset to where it's supposed to be. We've got a higher volatility. I know Jeff Yu is perfect to talk about that. The yields churn, I'll get to the 2-year chart in a moment. I guess, Francine, other than that, I'm going to go sterling. I can't afford to go to London.
No, that's it, Tom. Plus you're in quarantine for 5 weeks before we let you into the office. So it's just not worth it anymore. Global equity markets edging higher. Investors, certainly in Europe, taking stock of recent gains, weighing the implications of a soft U.S. inflation data. We're still pushing higher a little bit, but then pound 138.30. We're just pushing it higher so Tom Keene doesn't have to come back. Tom, Treasury 2-year yield. I know, it briefly dipped below 0.1% to a record low. I know you alerted to me as soon as we started the program, and I really think it's quite significant. The question of the day is actually, could we ever see a negative print?
I go to, among other people, I think of Steve Major at HSBC, but I'm going to give a shout out here to Jan Loys of JP Morgan and Joyce Chang and their research team over the idea of why or how do you go to lower yields. Let's bring up the chart right now. It's a cup of coffee. You can barely see it on TV. This is the pro chart. I had to make this so fast, folks. I didn't TVize it, so stay with me. The line for a cup of coffee is below that 0.10%. But what this is, Francine, is nothing more than liquidity. There is a wall of cash out there, and every once in a while, trends break, and we go price up, yield down. And it is a reality out there. JP Morgan, among others, has been articulate on this.
Yeah. Cup of coffee. Tom's cup of coffee is larger than mine. Mine are espresso, so it's a mess. On that serious point, we're back. Or actually, we'd love to be joined by Jeffrey Yu, BNY Mellon Senior Strategist for EMEA Markets. Jeff, when you look at Tom's chart, which was very good, especially since he made it in such a short amount of time, what does it tell you about what happens to treasuries? What if they were to go lower? Could we actually think about negative?
I would say that if the Fed is going to be keen on forcing markets lower, to force that view on financial conditions lower, we shouldn't just rule anything out at this point. So it is a sign that markets perhaps are giving up on that short-lived early normalization trade and just realizing with the variants, with the state of the pandemic, it really is going to take a long time before things pick up. And if we get banana skins in the meantime, absolutely don't rule anything out.
Don't rule anything out. Could it happen soon? I mean, what's your base case right now?
I think the base case is actually no, because we are in an environment where the market is just waiting for final confirmation of stimulus, and US actually, I think, contrary to expectations and certainly positioning at the beginning of the year, is maybe poised to do better or less worse on the reflation side of things. But again, if something on the health front or other fronts tips the world back into lockdowns, back into the very weak growth environment again, then I think it opens up the way to negative front-end yields and a whole lot of other things. But for the short term, I think things are not as worse as that could indicate.
Jeff, you're really honored to have you on today for such an ample time, and really a sea change here of the inflationistas, the worry of inflation, and the rest. A colleague of yours, Jeff, Stephen Englander over at Standard Charter, wrote a brilliant short note on inflation today, just saying, stop worrying about it. What is your history of what we do with a wall of cash? We all can identify we've got billions and trillions of cash laying around. What do we actually do?
Well, Japan would be the first place to go, as in for guidance, as in there could be a wall of cash, there could be rinban, money printing. That doesn't generate reflation. What central banks are saying right now is we are keeping financial conditions as loose as possible. Take that cash, go invest, go try to reflate. Government policy may try to encourage that, but we need to get those animal spirits up again. We need to get real growth, a real prospect of productivity-driven trend growth. Right. That needs to come through, but it's not happening. Who's going to direct it? That's the question
with
right
the
now.
nominal yields coming in and with inflation expectations, what they're doing, what are the effects to the financial system of an enhanced negative real yield, an ever more negative real yield at whatever duration you want to pick?
Well, here's where all the regulators and the policymakers, they need to be really, really careful. So on the one hand, on a price basis, interest rates, again, cheap funding costs, go invest. That is a simple message. But on the quantitative side, this is where I think the PBOC is giving you a pointer. They are heading down so hard on mortgage lending, on real estate lending, financial stability risks. That's not too far off the horizon either. So being able to direct the wall of cash in the right way such that it's productive, drives real growth, and sorry for the phrase, trickles down, that is the imperative right now, rather than just asset price inflation and potential financial stability issues.
Jeff, what happened? How is inflation different if the stimulus is targeted compared to if it's not targeted?
So if it's targeted, what I would target is basically productivity. If it's targeted at productivity areas which limit scarring, drives higher trend growth, then you could actually have real income growth. You know, this kind of wage-driven inflation, this is the healthy inflation that central banks want to see, and then they can perhaps think about normalization further down the line. If it's not targeted, then some of it could be transitory, some of it could be stale, could be gone to pay back debt, not generate any good price pressures, then it'll just be totally ignored, and we're just back to square one.
What's your take on dollar from here?
So dollar right now, we are still in the camp that dollar driven by real rates being held down is going to weaken. We are seeing asset allocation shift into Asia. Asia's probably the best play at this point. There are some select maybe commodity-linked currencies like Aussie, which is sort of quasi-Asia linked as well. That's doing well. And we are, through our iFlow index, starting to see inflows into European equities, both UK and EU. I think that's an asset allocation story as well, but I find that quite interesting.
Thank you so much, Jeffrey Yu there of BNY Mellon stays with us. Now, our Maria Tadeo in Brussels is also talking to the former EU chief Brexit negotiator, Michel Barnier, who I believe just said that they don't need to be congratulated for the Brexit divorce. Let's listen in.
Fair and free, the two words are important. And it is the key point, and I hope sincerely that based on these two treaties, the last one, it is the treaty on the future relation, but also don't forget the previous one about the withdrawal agreement, about the withdrawal of the UK from the Union 1 year ago. I hope that the cooperation will be and will remain clever between both sides, the EU and the UK. Huh? It depends on the way we will use this spirit and this treaty. And obviously we have put in this treaty some tools to prevent unfair competitions. I hope that we will not be obliged to use these tools, and I hope the competition will remain in the medium and long term, free and fair and free. You know?
And you say free and fair, you know, to some extent you're the perfect person to ask this question because you have to negotiate directly with the UK. In your mind, what kind of competitor do you think they want to be?
It depends on the UK. I cannot answer at that place. We have listened during the last few weeks, just after the signature of this treaty and the ratification on the UK side. In a few weeks, the European Parliament will ratify on our side the treaty. We have listened some words or some intentions about the duration of the labor legislations on one side, about the use of pesticide on the other side, the regulation of the financial service on the third side. So we have some reason to be vigilant. I hope once again that the competition, respecting the sovereignty of the UK and the autonomy of the EU, respecting the new legislative and regulatory autonomy of the UK, no problem, no question about that. I hope that this competition will remain fair and free, and I recommend that it will remain fair and free, because it is not the case we will use the tools included in this treaty.
Okay, and this is, of course, a business summit. There's been a lot of questions around the city, perhaps financial equivalence too. And yesterday there was an interview by the governor of the Bank of England that really caught my eye. He had some really harsh words in which he said, if this is about the European Union dictating the way that we're going to do business in the future, that's not going to work. And by the way, we don't really want to deregulate. When you look at the financial sector and equivalence, which way is that going to go? Or do you think in full equivalence, is that possible?
But first of all, when you speak and when we speak about the financial services, I recommend that nobody has a short memory on both sides, the UK and the EU, and if I may say, everywhere else in the world, because the financial crisis is not so far, and we have now to face the COVID crisis, which is very, very serious, with a lot of personal, human, economic and social consequences. But don't forget the financial crisis, not so far, and with a lot of consequences, in particular for jobs. So the key point for us is and will remain the financial stability of the Eurozone and the single market. And we will take no risk about the financial stability. No risk, because we had so many difficulties to rebuild this financial stability that we will take no risk. So this is the key line, with the red line, for the EU, where it will be about the equivalences, what we call the equivalences.
And that equivalence, is there a timeline or a time frame that you're looking at? I know you've said for us.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg Surveillance. Good morning, everyone. Francine Lacroix in London, Tom Keene in New York. I'm Maria Tadeo with Michelle Barnier there, driving forward the Continental Europe conversation. And we can get a quick brief here from Jeffrey Yu of BNY Mellon. Jeffrey, there's a lot of talk about vaccination dynamics between the United Kingdom, between Europe, frankly, the United States, on how it folds into growth in Europe. How far behind is Continental Europe?
It still is if you actually look at the rates. The UK's strategy right now is to complete the top 4 groups by the end of this week, actually. So apparently there's still about 2 million to go, whereas Europe, and there's wide disparities as well. I think the top country is Malta right now within the Eurozone, but there are some other larger nations such as the Netherlands, which are still well behind. So the risk is the ECB in this context needs to look at policy for the slowest vaccinator, and that actually could delay things even further compared to their current schedules. So I think that's an additional focus point when we look at policy differentials and exchange rates.
Well, exactly, that's where I wanted to go. We look at exchange rates, and there's an idea here of things breaking. Obviously, sterling's broken stronger, but euro has a certain resilience to it. Can you make a big figure call on euro?
So my baseline for the euro is even if things, let's say, don't improve from here, that 118 assumption contained within the ECB's staff projections, I'm more than comfortable with that as a base, not just in the near term, but probably for this year for the euro. And once vaccination rates begin to pick up, and then we start to see reflation, opening of societies and economies, and crucially helped by soon-to-be Prime Minister Draghi, perhaps, directing the NGEU investment plan into Italy, into the rest of Europe, then you really will see flows head back in. So euro still some value, but I think it's going to be a backloaded trade for the rest of the year.
Jeffrey, how problematic is rising euro for the ECB if it also has to deal with inflation?
In the short term, I think at these levels, they'll be comfortable with it. We're 3 big figures away from that 118 assumption, so I think they'll be fine. Again, it's about pace rather than outright levels. If you told the ECB at the beginning of January, we're going to get to 130 by the end of the quarter, they will absolutely do what they need to do to talk it down, to even take it down. But if it's close towards 130 towards the end of this year, I don't think that will mess around their inflation targets at all. So they're watching the pace rather than the levels right now.
Jeffrey, is there any, if you look at where you find value in Europe, do you have to look at first how money's like Italy spend the recovery funds, or is there more attractiveness elsewhere given how much the U.S. is spending in the stimulus?
I think really it depends on your asset allocation strategy. So again, going back to our flow picture, we are really seeing a lot of flow into European equities for the time being. Some of it may be hedged, some of it may be unhedged, but maybe asset allocators are taking the view, well, if you're buying European equities, as say German equities, for example, you're taking a view on global reflation. Manufacturing PMIs are doing well, there's demand out of China, so there's reason to actually direct money there anyway, irrespective of what's going on within Germany. If you're a bond investor, however, given where policy is, and probably there's going to be less to desire, the value may exist, though, in domestic European plays. If you think that vaccination rates will pick up and the investment flow will really start to rise and boost growth, especially in non-core Europe in the periphery, then you may start to see some of the intra-European flow head more towards the south as well. But right now, the flows are showing Europe is of interest to international investors.
Jeff, you're with us with BNY Mellon, and we will continue. It's good to have him for such a generous time this hour. Futures up 12, Dow futures up 79. The VIX comes in fractionally. It's really been quite stubborn. I'd also note dollar churning this morning. That euro, Jeff, you talking about 121.28. Coming up, William Dudley, the New York Fed president, that in the 8 o'clock hour of our simulcast. Stay with us. This is Bloomberg.
Frankfurt or Paris and some other places we have already relations with New York. It's not new. Number 2, Brexit means Brexit. It cannot be business as usual, I know.
have a very good chance to not only have positive growth, but perhaps a somewhat more encouraging positive growth.
The rebound in the second and third quarter will be quite strong because the expectation is that the vaccine will help clear the way to less restrictive lockdown.
We are going to have a recovery, but it's going to be an uneven recovery.
Of course, it will have direct impact on our growth forecast, and it will be very difficult to reach 6% of growth.
You're going to get a roaring 20s type of recovery and a boom period.
We are certainly seeing ourselves towards the second quarter being in almost opening the economy as much as one can.
We should not be too quick to cut back on the expansionary fiscal policy.
We'll get there. The question is not a question of if, it's a question of more when.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
My job has been all along this process to protect the single market and to explain from the day one to now that Brexit means Brexit, and we will have to face many consequences, social, human, technical, economic, legal, and financial consequences. And let me just repeat what I said the very first day, in my very first press point in December 16, many of these consequences have not been correctly explained. They have been generally underestimated.
And you say Brexit means Brexit, there's always going to be consequences. But
that was the former EU chief Brexit negotiator, Michel Barnier, who's sitting down with our Maria Tadeo for a discussion on Europe after Brexit. Tom, I was actually looking up, he's still the UK guy for the Commission. I think his job title has slightly changed because he's now head of the task force for relations with the UK, but really it's very similar to what he did in negotiating the Brexit deal. He now is talking about equivalence, and he says equivalence decisions will remain unilateral. He says the EU authorities will be vigilant if the UK tries to circumvent the rules. And once again, he basically says that they can't promise equivalence before the UK puts out their position. You can continue watching that one-on-one conversation with Michel Barnier on Live Go on your Bloomberg terminal.
And you're not open to it in any way, so renegotiating is not adapting.
We are open.
trading revenues coming in better than expected, everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
He's been talking to some of his counterparts in Europe. Tony Blinken has been talking to his counterparts. He had a long conversation on Friday with his counterparts in France, Germany, and the UK. And I think they're coming up with a coordinated, comprehensive strategy for how to deal with China. And I think once they're pretty sure that they're on the same page, and I think this will happen probably this week, Joe Biden will have that conversation with the president of China.
They should deal with China first, second, and third. I think it's very appropriate that the Biden administration considers China to be the most important competitor and adversary of the United States around the world. By the way, the Trump administration largely felt the same, so I don't see there's going to be a dramatic change here.
An important brief there from Ambassador Lukens and Dr. Bremer on China, and of course that conversation driven forward in the last, I'll say, 12 hours, maybe 24 hours by the Biden the Xi discussion. Jeffrey Yu is with us to provide perspective. Jeff Yu, the underpinning to power politics is economics. What is a GDP tone of the U.S. as compared to China? Do we just say China will be 200-300 basis points more economic growth than what we see in America?
I think that's generally accepted due to the stage of development China is at right now, and also as there's a probably greater scope for the state to deploy its levers. In March, one thing I'm looking for China's growth strategy is do they get rid of the growth target? It's already been openly called for some officials. But secondly, this year it sounds like they may loosen the purse strings a bit. So for once, they've actually pushed for fiscal stimulus, which hasn't really been as generous as in the past. So this could actually drive growth higher.
Jeff, you nail it. And then, of course, this was over the weekend, folks, a huge deal with the Goldman Sachs note out in the zeitgeist. Jeff, to you, with that said, what is their diffusement of fiscal stimulus domestically? Do they have the reaction functions, the processes, the mechanics to actually diffuse stimulus?
They do have let's just say, a working reaction function, but in the wrong places. You asked earlier about targeted stimulus. This is what China's tried to do. Can they target stimulus in a way that unleashes the consumer rather than get real estate markets and back up again? And right now, the answer is no. So why they've been cautious about fiscal stimulus in the past is you stimulate the wrong areas, even with good intentions. So they have to get it right this time around, use a lot of window guidance, moral suasion, and every trick in the book. But even if there's no growth target, I think deep down, I want to make sure that a lot of what was lost last year needs to be recovered.
Jeffrey, there was a pretty robust conversation between President Xi and President Biden, and I guess the main thrust was, "Watch out! I'm looking at you." Does it mean that trade relations could be even worse than they were under President Trump?
I think the baseline is things are not going to improve in the short term, and expectations are quite soft in Beijing as well. But it's interesting, the terse tone from the White House was actually not matched by the readout by Xinhua. So I think the White House released 6 sentences of the readout, about 8 paragraphs in the Chinese version, and it was actually quite effusive. So China understands there are differences, but asking for respect on some core interests, quote unquote. But overall, there's a sign of positivity, constructiveness. That was somewhat missing in the White House readout. So different people were getting different conclusions from the talk. But again, right now, any improvement or lack of deterioration, I think the market will take that after the last few years.
Yeah, maybe each of them actually speak to their domestic audience. Jeffrey, when you look at what will move renminbi, so how uneven is the recovery in China, and how can they address that?
So recovery is still quite uneven. You've got the tier 1 cities, which are still zooming ahead. I talked about real estate markets. That's what they're concerned about. That's especially in the tier 1 cities. The rest of the country needs a lot of support. So I think overall right now, I think China's in a place where they want to get growth higher. They want to make sure that it's balanced and lean towards the consumer. Will there be an acceptance of lower headline growth, but the right kind of growth and healthy, sustainable growth? in line with the 14th five-year plan, I think that's going to be the key test for the country and for the renminbi. The renminbi demand, we're still seeing it up. It's very, very, very strong.
Yeah, I mean, the renminbi demand is extraordinary, Jeff, from 7 whatever down to 6.44. I mean, it's a great untold story of the last 6 months. Jeff, do you just assume, a la Catherine Mann and Michael Rosenberg and, frankly, Steve Roach, that we're going back to the codependencies of before, or can you state there's a new relationship, a new dysfunction between these two powers?
I think the codependency is probably still stronger than the two powers would actually like to admit. But certainly, China's, again, the 14th five-year plan from the end of October last year, in one phrase, self-reliance, right? So that codependency wants to be removed from innovations such as CBDCs and also new frameworks for trade and balance of payments, and all of that is a sign that China wants to move away from it. But it's going to take a long time. That's why it was a five-year plan. But the strategy, the length of self-reliance, that's 15 years, right? And I would say 15 years at a minimum. So the relationship is still going to be strong on the trade and economic side for a long time to come, despite the politics.
But there's the heart of the matter, Jeff Yu. You've got a timeline of 15 years. Joe Biden's got a timeline to get to the primaries of November of 2022. What's the Jeff Yu timeline to get anything done here? Is it in between?
I think doing nothing or no deterioration in Sino-US relationship, that already is an achievement. And I think markets will take that as absolutely a risk positive. That is supporting flows into Asia already.
Let's write Jeff Yu's next research report, First Do No Harm. Jeffrey Yu, BNY Mellon, their senior strategist for EMA Markets. Just thrilled to have you with us today. Right now in New York, our first word news. Here's Ritika Gupta.
Thanks, Tom. Donald Trump's impeachment team is counting on a couple of words from the former president's speech on January the 6th. They will lean heavily on Trump's use of the words, quote, peacefully and patriotically when they make their case in the Senate. That's part of the defense against the charge that Trump incited a mob of supporters to storm the Capitol. House impeachment managers focused on Trump urging his supporters to, quote, fight like hell. And President Biden says the U.S. will sanction military leaders in Myanmar linked to this month's coup. Myanmar's leadership will not be able to access about $1 billion in government funds held in the U.S. The president says that humanitarian support to the country will remain in place. And Bitcoin is largely holding on to gains from its run to a record $48,000 this week. The largest digital currency was trading above $44,000 early today. Bitcoin jumped as much as 18% this week following the word that Elon Musk's Tesla had invested $1.5 billion in it. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine.
Thank you so much, Ritika. Now, former EU chief Brexit negotiator Michel Barnier sitting down with our Maria Tadeo. Let's listen in.
Once again, I don't want to comment what could happen in UK in the future. Huh?
Okay, and you know, if you look back, and I know you're writing a book, so I'll be very curious, A, to see when that's coming out, but also, two, at what point, you know, when you look at the optics that come with a deal, when you look at the moments where it has to be perceived as being difficult, what is the number one moment that you remember as being, that was the hardest, and I did feel at that point we were not going to get a deal?
But in your previous question, you asked me what will be what has been the difference between Theresa May, or what made the difference between Theresa May and Boris Johnson. The difference was clearly the majority in the House of Commons. It's so simple. Theresa May tried 3 times to get an agreement of the House of Commons, and 3 times she failed because she did not get a majority to support the deal she signed in Brussels with us. So it is the 3 times where I thought that we were going to a no deal because of the vote of the House of Commons. And a few months after, the end of the year 2019, Boris Johnson came in office as a prime minister. He provoked new elections. He won the elections, and he got a majority. And finally he got the agreement to the new deal we reached, because we have changed just a part. sensible part, important part about the protocol in Ireland, which is in many sense different the protocol and what we called at that time the backstop with Theresa May. But it was a good solution, agreed by everybody, or more or less everybody. It was an operational solution, not a temporary solutions, and on the base of this new draft of the treaty in October 19, Boris Johnson got a majority, and yes, this was the difference between Theresa May and Boris Johnson. No?
And do you trust Boris Johnson speaking on that? You know, we did see that. You know, he's a very...
And so there is Michel Barnier with Maria today. Of course, her wonderful work in Brussels through all of the turmoil of Brexit. You can see that on Live Go. An important... He seems, Mr. Barnier, I won't mince words, seems to be fired up. Fired up is the bond market, all of the fixed income world, looking at the shock of a burst just for a moment of the 2-year U.S. yield through 0.10. That was unexpected. We thank TD Bank in Singapore for good perspective on that. The 2-year yield driving down to a new record low. Coming up on beverages of your choice and on the consumption in pandemic, Alexander Ricard, of course, of Pernod Ricard. This is Bloomberg. Good morning.
Bloomberg is your best source for earnings, news, and analysis. On Thursday, Uber CEO Dara Khosrowshahi, following Uber's earnings announcement on Bloomberg Television.
And click on it, we make money. But now there's a big difference compared to other search engines. We use the money to plant trees all over the world where they are needed most.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Surveillance. I'm Ritika Gupta with the Bloomberg Business Flash. Uber is showing that demand for food delivery isn't making up for a fall-off in ridership. Sales plunged 16% in the fourth quarter, with the US especially hard hit. Despite the shortfall, Uber narrowed its loss in the fourth quarter. Volkswagen and Microsoft are extending their collaboration to include self-driving car software. VW's new software division will build a cloud-based platform with Microsoft that will help it simplify development processes and allow faster integration into its vehicle fleet. And here in Manhattan, landlords are offering record perks to fill empty apartments. In January, the value of incentives on new leases averaged 2.3 months of free rent. That's the most in more than a decade of record keeping by appraiser Miller Samuel and brokerage Douglas Elliman Real Estate. And once you subtract concessions, rents are down 19%. And that is the Bloomberg Business Flash. Francine.
Thank you so much, Ritika. Now, cognac and tequila, that's what people are drinking during the pandemic. At least that's according to the earnings out from Pernod Ricard. Those profits beat estimates after months of losing sales to bar and restaurant closures. Now, the French liquor company also says it's the beginning of a recovery for the alcoholic beverage industry. And we're delighted to be joined by Alexandre Ricard. He's the Pernod Ricard chief executive. Mr. Ricard, I was also explaining to Tom Keene, who lives in New York, first of all, what a perroquet cocktail is, and his mind is out of control. And then we also haven't even touched on the frozen Ricard. Mr. Ricard, thank you for joining us. When you look at what's being sold and what people are drinking at home, can you give us an update on where you're expecting Chinese New Year to be? How are sales going there, and how much of a setback is it that people are not traveling to see their families?
Well, listen, thanks for your question. By the way, it's the opportunity for me to wish a happy Chinese New Year to those that are celebrating. It starts tomorrow. In fact, it's starting tonight. The festive season is starting tonight. The stock market in China is in fact closed as of today and for the next few days. So from a sell-in point of view, we're fully on board and ready for a festive season. Now, the key question, in fact, as you put it, is how will consumer uptake be? Well, it's starting tonight, so it's going to be difficult for me to say. That being said, I do think we believe we're cautiously optimistic. We've had a great first half in China, up 13% in China, with our brands, in principally Martell, but all our portfolio of brands growing in all channels, whether the on-trade, whether the off-trade, and particularly as well the e-commerce channel, which is extremely dynamic.
Monsieur Ricard, what are you expecting actually tariffs to be like in the U.S.? I mean, I need to send over bottles of wine to Tom Keene, otherwise they're too expensive. Do you expect the Biden administration to take a different stance on some of these spirits sold from Europe?
Well, we do hope that the relationship between the European Union on one side and the U.S. on the other will go in the right direction and will be appeased. And obviously what the entire industry, the wine and spirits industry, are calling for, and of course of which Pernod Ricard is part of, is we hope to see the end of trade tariffs on both sides of the Atlantic. Of course, trade tariffs imposed on some of our whiskeys and wines in the U.S. and also on some American spirits in European Union. Hopefully, there will be an agreement one day, but it's beyond our control, as you can imagine.
Alexander, wonderful to speak to you from New York. As you well know, what you purvey is vitally needed in the pressures, the tensions of a pandemic, but it will be a changed industry. How will your industry change coming out of pandemic?
Well, first of all, what the pandemic has proven is the very strong resilience of the spirits industry. We have seen compensation of severe on-trade, so bars, disruption through home consumption. And these are trends that were already emerging before this whole crisis hit us. And I'm talking about, for instance, the home-tainment trend. People really enjoying entertaining at home with family and friends. We have seen the cocktail at home trend really accelerate over time. We have seen home deliveries accelerate as well. To mention Drizzly over the last a few months. And post COVID, people will go back in the trade, because the importance of human connections, of social connections, of the on-trade experience is even more so important. But the home piece, the home consumption piece will remain.
Tom's laughing because, of course, him and I don't drop, we don't touch alcohol. It's all kale juice since.
Francine, I know you want to get an important question on mergers and acquisitions. Can I just tell you the window display of Pernod Ricard at Candy Wines on Madison Avenue is an act of God?
Doubled.
Okay, continue.
Yeah, I think our home bar also doubled. Alexandra, is now a good time to look for M&A? Is it a good time for you to actually swoop up something that you'd be interested in having as a bolt-on acquisition?
Well, I mean, it's a great question. Part of our Transform and Accelerate strategic roadmap includes, of course, the pursuit of bolt-on acquisitions and, more generally speaking, the dynamic management of our portfolio of brands. And this is what we have been doing during and over the course of the peak of the pandemic. So a few months ago, we did announce completion of 100% of the acquisition of Monkey 47. Just to name that one, we acquired a vermouth brand in Spain called Petroni. We have signed a number of partnerships. By the way, a year ago, a little bit more than a year ago, we also had this friendly takeover of Castle Brands in the U.S. with that great brand of Jefferson's, and you should expect to see us do more of that in the coming months and years, of course.
You're at home with all of your decades of experience and your family's heritage. What's the biggest mistake you see when somebody makes a cocktail? Alexander, what drives you nuts when some American makes a lousy cocktail?
I'll tell you one thing. I'm not a purist when it comes down to cocktails because I have taken mixology classes. It's a great hobby of mine. But the one thing I would stress is when you see the wonderful spirits that you put in a cocktail, when it comes to the ice or the mixers, just make sure they're great quality ice or mixers. It's just like when you pour yourself, by the way, just an amazing, very expensive, high quality whiskey, just make sure your ice cube is high quality.
See that, Francine?
I like that. You know what my advice is never make it yourself. Always get the husband or someone else to do it.
No, I love the ice idea. I think I could see a new ice maker in the Keene household. Alexander Ricard.
By the way, we have great master classes, online master classes for mixology and people who are really interested in making cocktails at home when they cannot go out.
There goes the weekend. Alexander Ricard, go away or we'll never let you off air. Thank you so much. Legendary with Pernod Ricard, their Chief Executive Officer. Matthew Winkler, our Editor-in-Chief Emeritus, is going, this has nothing to do with business, nothing to do with finance. And we segue here from the making of a proper cocktail into the important discussion of Secretary Yellen. Matt Winkler joins us with a wonderful Bloomberg opinion essay. Matt, you and Shinpei always research. What was the surprise in developing an essay on Secretary Yellen?
So, Tom, it's always great to be with you. And what we focused on was everybody, of course, remembers that she was the first and only female to lead the Federal Reserve. What most people leave out in that biography is that when you compare her record to her predecessors and her successor, you find that Janet Yellen has, by the market's own measures, the most stability in financial markets of any Fed chair in recent memory. And you can look at it any way you want to, whether it's traditional economic figures or just market measures like volatility. She comes through as totally unflappable is the answer. And so that's what surprised us.
Okay, you taught me that the Fed worries about employment. The Secretary of Treasury has to worry about employment. What can she do to move the needle on 9 million people out of a job?
Well, she's already said that. She said, if you're going to make a difference, you've got to have a robust fiscal program. And that's what the Biden plan is. Now, it's not without its critics, as you well know, but her point of view is that it has to be robust and it has to be now. And that's the only way this economy is going to turn for the better to get people back to work and kids in school and all of that.
Matt, how should Secretary Yellen actually deal with rising inflation, or how will she do that?
Well, she has said in her testimony that we're a long way from the kind of inflation that Tom and I are all too familiar with back in the 70s. That era is pretty much gone for the time being. And so what you're looking at is if we do get inflation, it's not much faster and higher than where we are today. This is not the big threat to either the U.S. economy or the global economy right now, is what she has said. It's a different world.
Matt, I loved your piece because you go back to the idea that she's basically a reassuring figure because she's dealt with in the past and she has a great track record. But does that help getting the Republicans on board?
Well, I mean, everybody likes market appreciation and preservation of assets. And if you look at those two things, the 4 years that she was chair, stocks, bonds, the dollar, just about every kind of asset you can think of, was stable and appreciating. And, you know, a best way to look at her is coming out of the aftermath of the financial crisis. She was, and so was Bernanke, assailed for their so-called quantitative easing policy. And that got a lot of attention. But if you look at when quantitative easing ended, 2014, all right, October 2014, people probably forget that date. It was without much notice, and if you looked at bonds, stocks, and the dollar, they were all trading serenely at their highs for the year by, you know, the end of 2014.
Matt, we got to leave it there. We're out of time. I demand that you and Shinpei do an essay on what you've been dead on for a decade, which is the inflationistas just flat out have it wrong. Maybe they do. Maybe this is the time they go up. But I can tell you across the span of Bloomberg News, we've done lots of important journalism on, wait a minute, maybe inflation's not going to go up. Look for his essay in Bloomberg Opinion. Coming up in the next hour, linking in this question of price change with the foreign exchange market, Jens Nordvig, Exonic Data, the best Wall Street analysis of the pandemic. We will get an update on his pandemic research as well. Futures up 12, Dow futures up 73, the VIX 21.83. The VIX goes nowhere. The VIX ought to be at 20, 19, you know, take away the fear, 18, not 21.83. New record low on the 2-year yields. Stay with us. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
This morning, the inflationistas, well, they incite fear of inflation. The data says otherwise. Amid economic contraction, there is disinflation. Yields move lower, the 2-year to a record low. Best-in-class vaccination incites, well, a run on pound sterling. Did someone mention go long the FTSE? When did I last say that? And the Senate and the House, they are stilled as clear and present video shows an incitement to riot. Good morning, everyone. This is Bloomberg Surveillance. I'm Tom Keene in New York, Francine Lacroix in London. Francine, we got through the 5-hour in New York without impeachment talk. It has riveted a certain part of the nation, and as many news stories say, there's a rest of America just moving on, and they're removed from it in their support, direct or indirect, of President Trump.
Yeah, Tom, what I'm surprised is who I've been following it quite closely because it's interesting. And I think it really has captured the imagination of Europe that for such a long time has been, looking at the U.S. as a beacon of democracy. And there's almost this, looking into the looking glass into how the U.S. operates. I'm surprised at not surprised, but actually, it's, we've moved on and there's so much of these video usage. And I have to say, it's really quite vivid imagery that they're putting out and that also the media can look at and the general public. But Tom, I was intrigued by the 2-year Treasury yield at a record low, and Jeffrey, you really saying, anything could happen next.
Well, there it is, and we've got the perfect guest for that. We'll get to Jens Nordvig in a moment. I mean, this is extraordinary, folks. The wall of money that's out there that changes all the fancy academics that everybody's got in their head. There's just nothing like billions and trillions of dollars of liquidity to change the surveillance calculus. Right now, our first word news in New York, here's Ritika Gupta.
Thanks, Tom. House Democrats are building a case against Donald Trump using his own words and chilling new video of the storming of the U.S. Capitol and lawmakers' escape. They laid out their case during opening arguments of the impeachment trial in the Senate. One of the arguments that the former president tried to sow doubt about the election results months beforehand. And Joe Biden raised a number of concerns in his first phone call as president with China's leader Xi Jinping. According to a White House account, the president spoke with Xi about what was called China's coercive and unfair economic practices. He also brought up human rights abuses and restrictions on political freedom in Hong Kong. And the European Union has rebuffed the UK's call to reset their post-Brexit relationship. The bloc says that the British first need to honour the promises it made on Northern Ireland as part of the divorce deal. The UK has asked the EU to delay the implementation of border checks on some goods entering the province. And in Japan, former Prime Minister Yoshiro Mori reportedly will resign as head of the Tokyo Olympic Organizing Committee following remarks that demeaned women. That's according to TV Asahi. There's been growing criticism over Mori's comments that adding women to the board of the committee would lead to more talking. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Tom.
Ritika, thanks so much. Let me get through the data check quick. There's so much to talk about. Futures up 11. We've got a continued equity lift in the market after the Tesla Bitcoin pullback yesterday. Bitcoin 46,000 like a rock. The yield, well, the yield churns here. I've got some curve steepening this morning. Not much going on there. Francine, I'm struggling. How about 138.24 on sterling?
Yeah, so sterling continues with the vaccination, of course, story, the fact that they're miles ahead for the moment than everyone else in Europe. But I think part of the conversation will also turn on Brexit and the new relationship, including equivalency. I'm looking at, some of the technology stocks here in Europe, and they're definitely leading gains. Investors, again, taking stock of the recent market gains and weighing the implications of soft U.S. inflation data, Tom.
Very good. Let us begin with Jens Nordvig. I want to do a chart now. We'll do the pandemic with Jens Nordvig in our next block. His work is just absolutely inspirational there. When the facts change, the market changes. The fact is there's a wall of cash out there, and we saw the stunning move of the 2-year yield today through 0.10%. Jens Nordvig of Exante Data synthesizes foreign exchange and rate analysis like no one out there. His book on the euro was prescient and requires a reread. Jens, good morning. I want to talk about the 2-year yield, the wall of cash. Jan Loy's over at J.P. Morgan has a vector to lower and lower yields. What do the inflationistas have wrong?
Well, so we have a liquidity effect going on in the short end of the curve. It's very ironic what's going on. Like we have all this talk about potential overheating of the U.S. economy, and the long end is moving up. But actually, over the last several months, like we've had a downward drift in the short end, right? So this cycle is different from any other cycle, and the same holds to the short end of the curve, which is really being compressed down towards zero. And there's a risk even that we can go into negative rates in the U.S. by this extra release of liquidity that's coming from essentially some technicalities about how the U.S. government managed its deposits at the Fed, and they are now being released. So it's a very interesting situation where we have concerns in the long end and opposite dynamic in the short end, and it's certainly impacting markets, and the currency market is one of those that are looking very closely at this.
How do you link dollar dynamics into what I presume will be a significant and rapid curve steepening?
Yeah, so I think when you look at essentially the relationship between what's going on in rates and what's going on in FX, we tend to look at essentially when you have a parallel shift in the curve, the whole curve moves higher. That's something that's very powerful for FX dynamics. But at the moment, you have like something that's very different from that. You have the curve steepening very dramatically, and that doesn't tend to support currencies very much. The dollar is a currency as well. It doesn't tend to support the dollar that much, if at all. And it certainly depends on the crosses, right? Because you can also see what's going on now. You talked about the UK in the intro that has now its own sort of bullish dynamic going on around the vaccine rollout there. So in the UK, actually, the short end is starting to move higher because at least the cuts that were priced there are being priced out, right? So we have a lot of talk about the US being exceptional, but it's also exceptional in the sense that they have actually the rates in the short end that are going down the most at the moment, right? So that generates actually a bearish argument against sterling, for example.
Yeah, and yes, I want to talk about sterling in a second, but if we go back to, dollar dynamics that Tom was alluding to, what happens if we have a negative print on the US, 2-year yield, for example?
Yeah, so I think the most important segment for the dollar on the curve is the short end. Like there's a lot of players that will be paying attention to what does it cost to hedge, right? And people could typically hedge for 3 months to 6 months, right? So all those short instruments that are going to be correlated with each other, like what's going on in the T-bill market is going to be correlated with the FX forwards, and those are the FX forward rates that hedgers have to pay. So it is directly relevant to what's going on in the currency market, and therefore it's something that we should definitely pay attention to. Obviously, we're not talking about hundreds of basis points of move, right? We're talking about maybe 10 basis points of a shift we can have, but it's still relevant, and it's especially relevant because a lot of people have gotten so focused on the move in the other direction, the long end, right? So it's really countering that, and it's dramatically weakening the argument that the move in the long end should support the dollar, because we just have this very unusual situation where we literally go in the opposite direction.
Jens, going back to actually what we're seeing in the UK and the big move in sterling. So, of course, it's partly because of what COVID vaccinations are looking at, which is here in the UK really far ahead anyone else in Europe. But how much is there also a belief that now that Brexit has happened, the UK will slash taxes to become a kind of Singapore on Thames?
I think, to be honest, the vaccine rollout is very important. If we think about, okay, what is 2021 about? 2021 is about investors hoping and expecting reopening, and it matters greatly whether you can reopen in March or whether you can reopen much later, right? And the UK now is on a track where we think the hospitalizations should start to really see an impact from this vaccine rollout within weeks. And when I say hospitalizations, I mean the proportion of people who get infected who have to go into the hospital. I think that's the key policy metric that people are going to look at. If that really starts to come down, that means that we've turned the corner. The vaccines are working. I think we will see concrete evidence of that within weeks. And once that is seen, we will have the reopening announcement. And the UK is going to be ahead there, and I think that's going to be very important for how sterling trades. It already is important. In addition to that, we've had essentially the negative rate debate in the UK within the Bank of England has been put on hold. We're not going to have negative rates within 6 months. That's what was said at the last Bank of England meeting. That was also important. So I think those two things are important. And then obviously we can have discussions about what's going on with Brexit. We've seen many anecdotal stories about it's hard to fill in the paperwork and so forth. I think that will be resolved. So we are sort of in a sweet spot where actually most of the factors are stacking up bullish for sterling. And I think for the next couple of months, that will be the driving force.
Tom, the only pushback, and I know we'll speak to Jens a little bit more about that, is actually the UK, let's remember, I think is one of the only countries in Europe where schools are still 100% closed. So the idea that it can reopen very quickly is we're in so deep lockdown compared to France and Italy and even
I think
Germany
compared to
now,
here as well.
that, you know, I would just caution a bit of how quickly the UK can get back.
Well, all of our viewers and listeners know it is a huge deal. We're going to come back with Jens Nordvig on his ownership of pandemic analysis. He's really been wonderful at Exante Data. Futures up 12, coming up on the policy of Washington when they get back to it after impeachment. Ms. Cantrell of PIMCO. This is Bloomberg. Stay with us. Good morning.
Analysis. On Thursday, Uber CEO Dara Khosrowshahi following Uber's earnings announcement on Bloomberg Television.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Bloomberg Surveillance. Good morning, everyone. Francine Lacroix in London. I'm Tom Keene in New York. Let's dive forward. Jens Nordvig to come back with us here in a bit on the pandemic. Right now on Washington, and a different Washington, a changed Washington, Libby Cantrell joins us with PIMCO. Libby, I know it's easy to go to fiscal worries and inflation worries, but what does the actual deployment of $1 trillion+ look like? What is your guesstimate of how it will actually be diffused into the system?
Yeah, well, good morning, Tom. That's a great question. I think that's what all policy analysts and economists are trying to figure out. I mean, it's going to be bigger than $1 trillion. It likely is going to be, much closer to that 1.9 trillion that Biden had laid out. Now, some of that is going to likely have some lags to it. So about $350 billion of it is state and local funding. That will likely take a while to get into the system. Some of it will, be more front-end loaded. Of course, these stimulus checks. Now, how do people actually spend those checks immediately, or do they save them, as was the case actually even in the December stimulus check? So I think that the number here is massive. It's extraordinary. But the actual impact to the economy may not be as sort of front-end loaded as you might think. Again, just because of all these varying dynamics.
I look, Libby. I look at where we are, and there's just we're waiting for impeachment to be done. When do we get? The simple question is, when do we get a check in the mail? But forget about that. When do we get the impulse of fiscal stimulus? My guess is it's a lot farther down the road than anybody wants to admit.
Yeah, I mean, in some ways, while our clients are very focused on the potential of inflation, and for good reason. I mean, we are just flooding the economy with both monetary and fiscal stimulus. In some ways, we view this fiscal package just as much as a protector of downside risk as an increasing potential upside risk, inflation risk. So for all of the reasons that you all just talked about, in terms of the mutation of the virus, lackluster vaccine rollout, for all of these reasons, we think again that this could be as much of a protective of a downside. You saw the fragility in the jobs number, the poor CPI print yesterday. So none of this is necessarily pointing to an overheating economy. If anything, it's underscoring the fragility of the U.S. economy. And so as a result, the sort of big, bold, fast and simple approach that Biden is using, I think there's good reason for it.
Libby, good morning from London as well. What will happen to U.S. productivity?
Yeah, that's a great. I mean, Francie, these are all great questions. I'm not sure we have great answers. I think some of this obviously. Much of this is going to, here in the U.S., is going to be dependent on the rollout of the vaccine. There's some indications that is getting better and improving, but this is sort of the casualty of the federalist system, is that these states are doing it kind of on their own, albeit with arguably more federal support over the last few weeks. So again, kind of big question marks here. I think that the question for us in some ways is, after you get through this kind of COVID relief period, when you're from a fiscal policy perspective, then what comes next? And that is, I think, then there maybe is a risk of some upside inflation pressures. But even then, we think that the fiscal authorities really have a big kind of infrastructure package in mind that kind of speaks to your productivity. Your question, where we actually think that type of fiscal stimulus could arguably help productivity and therefore, mute again those inflation risks. So obviously, lots of big question marks. But I think most importantly for my world, which is what I look through, I mean, the Biden administration is plowing ahead again, kind of big and bold, simple, fast, and partisan. And this is unlikely to get much Republican support, at least in the Senate.
Libby, is there one part of the economy that they really need to focus on to target? So is there one part of the economy that, if you see it being targeted with the stimulus or the relief package, you feel better about the path forward for the U.S.?
Yeah, well, if you talk to our Muni desk, they will, I think, just call out the fact that state and local funding here, even though revenues have actually come in higher than I think many people were expecting. There's quite a lot of fragility at the state and local level. Plus, they're having to spend a lot of money on things like the vaccine rollout. So I think that we will welcome the fact that this package is very likely going to include a very big portion of money for those state and localities, because again, I think there's been a lot of pressure on them, and they've only received about $150 billion in all of this money that Congress has appropriated. So we do think that's been kind of a big miss, and we welcome the fact that this package will address that.
Libby, explain the efficacy of the distribution to states and localities. A, do we know where the money's going? And B, is it a really constructive use? Like we know stimulus checks get consumed or saved. I get it. But what about state and local billions?
Yeah, I think what we saw from from the CARES package back in the spring, I think this is one of the reasons why there hasn't been more money going to states and localities, is that some of the states really didn't necessarily either need it or need it immediately. It looks like this $350 billion, more or less, that looks like it'll be going to states and localities. There will be a portion of that will just be divided evenly across all of the states. But then there will be sort of a top off for those states with high unemployment numbers. And we think that makes sense, right? Really trying to target those states that are kind of suffering the most. But there will be a baseline figure because this is Washington, as you know, Tom. Every senator needs to get some money for their state, so there will be sort of a baseline amount appropriated to all the states.
Libby Cantrell with news you can use there. Thank you so much, EVP of Head of Public Policy for PIMCO. Greatly appreciated this morning. Coming up, there are a set of mayoral candidates for this great city. Andrew Yang will join us in the 8 o'clock hour. Stay with us. This is Bloomberg Futures, up 13.